Going live, Ryan, and we'll get the show on the road here.
You are live.
All right, welcome everyone. Today is April 17th. We are reviewing our trading plan, and the outlook remains the same. Stock market crash, massive bond rally, deflationary pressures from a demand shock, and at the same time, the cost of goods are quite likely to rise as everyone wants to stay home and collect free unemployment checks. So this is a recipe for a depression. We're going to review our trading strategy and what's really impacting that trading strategy. So the first thing we really need to point out is what's causing the economic drag, and everyone knows what that is exactly. Yesterday we were looking at what our predictions are causing this economic downturn. A lot of people said, wait, isn't this a trading webinar? And yes, it is. But to predict the future, we really want to predict what's happening. Up on the screen, I have two charts, or rather one chart. We're going to look at a few more. You can see Italy, Spain, and France are showing a decline in deaths. And yesterday we had the administration come out with the guidelines to open back up the economy. So far, governors who don't feel they have a problem in their state are coming out saying they're going to begin reopening May 1st. So I do want to point out a few differences of what happened with the successful countries who are so-called flattening their curves: Italy, Spain, France, and China. Now, China says they're down to zero, if you believe that. Italy, Spain, and France, I do tend to believe their data, and we can see US, UK continue to struggle. So Italy, Spain, and France had a extremely hardcore lockdown that continues to be extended. In the US, however, we have failed to have such a strong lockdown. So I do fear that we may see the daily death count flatten for a few weeks here, but continue to rise exponentially. And this is going to be an absolute disaster. It could potentially delay our timing on adding more puts. We'll take a look at what's happening in the Fed's balance sheet. All good news for our positioning, and also what I expect coming forward. Okay, so that's the first thing, is that we did not do a proper lockdown, and now the administration is really in a bind. If they keep everybody locked down, you piss off a lot of people who are now creating gridlocks around cities, protesting at government buildings, and really a lot of the core base for the Republican Party is not happy about losing liberties. So they made a pretty smart move politically, I guess you could say, is that now he's pushing the blame on the governor to make that call. So very interesting, lots of pressure to reopen the economy. People do not like being stuck at home. It's very taxing on psychology, your pocketbook, and a number of other things. So it's really just a lose-lose situation, no matter really what you do. So my forecast is we're going to speed up the timeline to really making this widespread in America and end up with a much longer lockdown in the future. That's going to be again, speeding up the crash. So that's good for our goals to get situated into some very juicy equities coming up potentially around August, September. So if they had kept us in a lockdown for a much longer prolonged period, they could keep the death count lower, the spread lower, and that could lengthen how long this stock market crash could take to play out. So let's take a look at some other information. But again, we did not take the precautions of Spain, France, or China, not even close. So I do expect that the death count and new case count will continue to climb into 2020 and result in an even more severe lockdown. Meanwhile, the food lines are building. Here's an article from Business Insider. Hungry Americans are waiting in mile-long lines as food banks struggle to keep up with demand. Here's a look at how rising unemployment and dwindling volunteer pools are impacting U.S. food pantries. The small business, here's the first mayor announcing that they're going to reopen starting May 1st. Now, again, this will be a slow, gradual reopening and still highly limited in terms of what people can do. But again, we're not seeing any slowdown whatsoever in the death toll, and the actions we're now seeing pushed out are going to help accelerate that. Okay, so let's take a look at the death count. This is a key indicator. I don't trust that we can test enough people to really count on the active case count. And so really the best indicator is just simply watching the death toll worldwide, the death toll in the United States, and then I do like to look at the active case count in Singapore. So we can see yet again, there hasn't been a single day yet since I've started tracking this, which was before January 22nd, as you all know. This is a logarithmic scale, 10, 100, 1,000, 10,000, 100,000, 1 million. So it makes it harder and harder for this to continue look like it's going up on a log scale. That does represent exponential growth. And so this thing is just nonstop taking people out. If we go to the next chart, this is just in the United States. And you can see we had a jump to 34,000 deaths, 32, 29, 23, 22, 20. So again, I'd expect this to perhaps flatten or slow down at least for the next 2 weeks. And then as we begin seeing opening of different economies, and really it's just the social pressure to isolate. I think that's going to feel like it's just not that important. So I do expect this to start rocketing back higher, probably by the end of May. Next, if we want to hope that warm weather could be a beneficiary to slowing the spread this summer, everybody's had their eyes on Singapore. Now, again, I was checking this out way before everyone else. It didn't take long to figure out where is a advanced civilization, which is Singapore, probably one of the most advanced, if not the most advanced on the planet, with health, with technology, with security, and also with hot weather. So never gets cold in Singapore currently. And you can see their new cases are exploding higher on the linear chart. If we go to the logarithmic, it's exploding higher as well. In terms of death count, they've done a good job at reducing the death count. But what's important here is, again, it's that a huge chunk of the people who do catch this end up needing hospitalization. And that's what's going to create a number of effects. But in general, it's slowing down our economy. It's creating a change in consumer buying behavior. And it's also creating a increased cost of goods because nobody wants to go to work. To review the statistics that I'm looking at to get a better gauge for when we're nearing the end of this transmission of the disease into the population, so we can get herd immunity. That's really, it's either we get herd immunity or we get a vaccine that really solves the core problem that's causing this downturn in the economy. Is this data right here. So if we have 7 billion people, and I guess it's now 7.2, and then we assume that half of the population's at risk of being infected, and it quite likely is more than that, but let's just say it's half. Of the half that could potentially catch this disease, 1/3 seems to not have an issue, whereas about 2/3 seems to have pretty severe symptoms. Instead of assuming that, we're going to do the opposite. So I'm going to say only 1/3 of those who catch it will actually have symptoms. Of the third that does catch the disease, currently it's 20% need to be hospitalized. But let's cut that in half to 10%. We're looking at 115 million people who are going to lose oxygen and essentially suffocate. Okay, so that's what is truly the economic shock. It's not necessarily those passing away, although that does have a ripple effect. It's simply losing your ability to breathe and being forced to go to the hospital, where they do a lot of stuff to keep you alive as best as they can. Now, unfortunately, so far, the percentage of people who do end up in dire straits and need hospitalization, the survival rate's very low. In fact, it does look like it's less than half will survive if they end up needing a ventilator. But let's just reduce that and say that only 1 out of 4 who end up needing hospitalization will pass away. So yesterday we were at 136,000. We'll update today's figure to the current 148,000. And so if we look at what percentage of the population by this estimate has already had the disease, well, we have less than 0.5% of the transmission completed. Now, we do know that the death count is a lagging indicator. I like to use it because I think it's the only accurate indicator we have. There's just too many people to test, and there's not enough tests. So let's just say we were 10 times behind the actual spread. So if we did think that this was growing every 2 weeks by a factor of 10, which has been the pattern, at least before we started doing lockdowns, then that could potentially be a realistic figure right there. So in the best case scenario, we're 5% done with what the effect of this virus will be. Now we can slow this down by having lockdowns and social isolating. But again, that comes at the cost of crushing your economy. So it's just a battle that you can't win. And I believe that we're just barely at the tip of the iceberg for the damage this will do on our economy. So that's really the summary there. Another thing I do want to look at is so everybody wants to know, okay, so everything looks terrible. We've got unemployment, we've got oil crashing, there's no demand for oil. China came out with negative 6.8% GDP, the first negative print since the 70s. There's food lines. Average Americans lost 25% of their income. Every job created since the great financial crisis, 2008, 10 years of job creation was wiped out in 1 month. The small business loan program, which is designed to save jobs and keep that unemployment number from getting outrageous, is out of money. So what on God green's earth is creating this stock rally? Well, I will show you exactly right here. So every Thursday at 2:30, they release the H41 release from the Federal Reserve's balance sheet. Now, they took a long time to get this out yesterday. Who knows why? It doesn't seem to be the most complex accounting, as they're only supposed to buy a handful of assets. And what we're going to look at is the growth of the balance sheet as this crisis really began to unfold. So they do tend to be very reactionary, and it looks like they're getting ready to let the markets go. Kind of imagine taking those training wheels off your kid after he just crashed, and you put him right back on, and now we're getting ready to take the training wheels right back off. So this is March 5th, and again, this is just a simple sheet from the Fed every Thursday telling you what they've bought, what they've sold, and how much they've expanded their balance sheet. So on March 5th, they added $25 billion to the balance sheet, and this is when all the chaos began. March 12th, they've added $77 billion to the balance sheet. March 18th, or the week of March 19th, they started to really amp up purchases, $240 billion added to the balance sheet. March 26th, here comes the big bazookas, $506 billion added to the balance sheet. Almost all of this is going to only two assets. It's U.S. Treasuries as well as mortgage-backed securities. Now, they have been investing in a lot of different other special purpose vehicles they've created, including providing free money into corporate bonds, even at the junk level. So they just came in with a Band-Aid for everything under the sun, indiscriminately, extended credit lines worldwide to other central banks, essentially forcing the treasury market to stay intact and allowing everybody to pull a profit off their bond positions. And that's what's been buying up securities. Here's the biggest print, $605 billion, April 2nd. And as you'll see in the next few prints, they have been dramatically tapering this down. Now, they just can't print money forever without a lot of consequences. That's why they just don't do this all the time. And instead, they tend to do it during crises. Okay, so the print from April 9th, $393 billion. And the print yesterday, $228 billion. So our game plan for playing the markets is to probably wait at least one more week, perhaps two, and continue to see that balance sheet taper off. And that's when we'll begin to add to our short positions and get a little more aggressive on our TLT positions. Now, the giveaway that this is a very nonsensical rally is really seeing that this massive jump in the SPY didn't crush the TLT. Okay, because like clockwork, the market has an inverse correlation between the TLT and the SPY. You can see quite often when we have jumps in the SPY, you have crashes in the TLT and vice versa. So you can see this healthy stock market rally from 2017 into 2018 caused a 8% pullback in the TLT. But a similar move just recently in a single month actually had the TLT rise in value at the same time that the stock market rose. So let's pull up our treasury product. Here's our treasury market. And so the TLT just continues to hold strength. Of course, it's being actively purchased by the Fed, so that helps. But really, rate cuts are what drive the TLT higher, and quantitative easing is what drives the stock market higher. And it is my anticipation that they're going to slow down and eventually stop quantitative easing and allow the treasury market investors to be forced to buy and hold, because they do have to start converting all the debt that the Treasury picked up, which was $1 trillion in the Treasury's coffer just in the last few weeks, all in the T-bill area. So they need to roll that from short-term debt into long-term debt. And that's what's coming next. And that's really what's going to start sucking money out of the markets. And again, I do anticipate it'll be primarily headed to the TLT. So for those of you who want to know why stocks are rebounding, we came in right here at the 240 level, as you know, with our first tranche of put options. And then the Fed came in with $1 trillion and bought the market a month of time so far. But again, they are tapering that down. And that was an expensive little rally that did devalue the Fed's balance sheet by about 25%. So stock market's extremely momentum based. The second this rally starts to slow down, all of the trends trading strategies will start to short this. So we'll see how long they can keep it up. From our timing, I'll be watching the balance sheet this Thursday coming up. If it drops dramatically, we may pull the trigger next Friday to increase our put option position. But if it's still above $200 billion, I quite likely will push it off one more week. So that's really the big movers hitting the markets. Let's review our trading strategy. The webinar teaser today points out the drivers of oil price and unprecedented fall in demand to continue weighing on oil prices. Okay, so this is probably your single best indicator. Let me find our oil chart. This is really your best indicator to how healthy the markets are, is the ultimate energy product, oil. And we can see that it is still at least 50% below where American oil companies can make a profit. And there's really no hope in sight for the oil markets. So I do believe we'll see oil make its way back up to 50 in the course of time. But we also got to keep in mind what's the output of oil, because it's the cost of oil times the output that really gives you a feel for how strong the economy is. And so this really tells you everything you need to know, and continues to have downward pressure here in the crude oil markets. And this is with all sorts of manipulation from the administration trying to negotiate cuts in oil, buying oil reserves for the United States, and even paying the oil miners to leave oil in the ground is what they're now resorting to. So just the general move by the government has been to tell everybody, don't worry about any malinvestments. Don't worry about making money. We're going to bail everybody out and you can just sit on your hands. And that, again, is not bullish for growth in the stock market. Okay, so let's hop to our trade alert and then we'll take a break for Q&A. So America has to get back to work. We're going to go broke. They can't afford to do what we've been doing for the past month for much longer, as it would eventually crush the dollar, which again would result in people dumping everything that's US based. So if they print too many dollars, what are you going to do? You're going to sell any asset that's associated to those. So that would mean a collapse in your stock and bond market, and potentially even your real estate market at the same time. So there's a limit to how much dollar printing can occur. And as you can see, they are dramatically reducing that now that they believe they've stabilized the market and at least gotten some fresh powder into all the big banks by picking up their treasuries. So the world will reemerge. The spread will be back to a very fast pace in no time. The economy will be at a limited output for the foreseeable future. And it's a very, very worrisome time for America in the next 12 to 24 months. So let's take a look at our portfolio positioning. We have really two parts to our program. If you're in the basic membership, you trade Monday, Wednesday, Friday, US equities only. We are simply buying this set of put options and then relaxing and sitting back for a market crash, which I do believe will begin within 4 to 8 weeks, but potentially much sooner. So we have this set of put options that are a buy and hold recommendation. Currently, it's one set of put options per $75,000 following the program. As soon as I see enough consecutive decreases in quantitative easing from those Thursday reports, do expect me to increase these 4 positions and potentially add 1 or 2 new expiration dates and strikes that'll be further up. So I still like these puts. We have not sold them. And again, remember in 2008, there were plenty of rallies that went 4 to 6 weeks in duration during the market crash, and 3 trading days represented almost all of the market crash in 2008. So we can get to our strikes very quickly, and it'll be at the snap of a finger. So it really doesn't make sense to not have your downside puts at all times. Is it unfortunate that $1 trillion came and pumped up the stock market for a month? Sure. But had that not occurred, we saw that those positions were immediately in the money the day after we put those trades on. And I believe they are going to, again, slow down the growth of the balance sheet and start focusing on trying to roll over the short-term debt into long-term debt, which, again, they have not even begun. And that 30-year treasury typically sells on the first week of each month. So could potentially see that causing some trouble going into May. So to reiterate, this is our strategy for basic members. We're staying in cash per $75,000. This is your set of puts. After at least one more consecutive drop in the Fed's balance sheet, perhaps two, I do intend to add to these positions, and we do remain long. And I'm highly confident these trades will work out very well for us, as it just takes a handful of down days to really move the market lower quickly. Now, this acts as the foundation for our trading plan. I like to use the analogy of a house. This is our house. It gives us coverage into 2022. So any drawdown you have in your puts, keep in mind you have months and years of time premium in these positions. And so there's really nothing to worry about. Now, we consider the cash the walls of our house. I've updated this chart. You can see ONLN is near an all-time high, driven primarily by Amazon. And again, I do believe the entire market is going to crash, including your hot companies like Amazon. Because if you have an economy that's going to be cut by at least 25%, perhaps 50% for the foreseeable future, then you have to reprice every corporation under the sun. Many will go bankrupt, and the end result is that, again, you have less people with less money, which is going to hurt consumer-based companies such as Amazon. So these are the set of ETFs we want to buy, which I believe will be around August or September. And these are going to be direct beneficiaries of the changes in the economy that I foresee. So healthcare, biotech, medical device, e-commerce, and then the aero defense ETFs are what I believe will outperform their peers after we've had a repricing of assets. So right now, it's absolutely ludicrous to believe that the market in April, as we have record unemployment, low bankruptcy level oil prices, and foreseeable lockdowns into the future, it's just absolutely ludicrous to believe that the stock market should maintain the same valuation. So this is really a blessing to get this big bounce, as it will allow us to get a much bigger drop in the S&P 500, which means a lot larger profits for our portfolio. So very happy. Now, when I place those first puts, I'll tell you what I was wishing and praying for was something of this nature to occur before entering those puts. It just looked like they were going to let it crash and bail out the economy much later. So we had bad timing on that. But again, we were smart. We didn't risk the whole farm, and we bought ourselves lots of time premium. So in the grand scheme of things, I'm actually glad that this bounce has happened, as it is going to give us an opportunity to get that average cost of our put options down and achieve a much bigger snap in the market, as well as a spike in volatility. So keep in mind, the higher volatility goes, the greater your return on put options, because it makes the implied volatility shoot up the price of that option. So the truth is, if these strikes go into the money before our expiration dates, we'll actually make more money having it shoot up and then go back down, because the acceleration of the decline or the volatility index will be much greater than had it just dropped from where it was. So I know all of you who did get this first entry point have some drawdown in this position, but again, no changes, no concern, and do expect to expand on this position again after we've seen the balance sheet reduction for at least one more week, but perhaps 2 to 3 at the most. So as far as what I'd expect, this to go below 200 next week, and then potentially see a 100 print the following week. Now that's just half your house, and this is great for most investors who really have a simple $30,000 to $75,000 portfolio they want to manage. For those of you who have larger assets, this is much smarter, and we call this the roof to your house. That's your bond position. The TLT is really where you want to go if you believe there's economic downturn ahead, which is without question, as well as the best asset if you think there's going to be deflation rather than inflation. So we've seen gold miners have quite a bit of a rally lately, and we have the same strategy, but slightly optimized for these two assets. So I believe in the coming years, we'll see a huge push in bond valuations as interest rates go lower and lower, followed by inflation coming down the pipeline, perhaps in 1 to 3 years. So that's really the big plays I see as a stock crash, a violent stock crash to start off in 2020, then a slow, steady grind on the TLT for several years as this slowly but surely turns deflation into inflation, which is where I believe we'll see our biggest push in gold miners. So right now, most of our eggs are in the TLT basket. About half your assets between the call options and the long ETF position are allocated in the TLT. We have about 12% in gold, but it's protected with put options, so our real risk is closer to 1%, not 12%. And the reason we're getting in early on gold is simply because we're seeing quantitative easing and rate cuts at the same time. So this is different than we've seen in any other crisis. And really, the cue to buy gold is the devaluation of currencies. But they're doing that devaluation for good cause, and that's because of the demand shock and massive deflationary pressures. So we'll take a look at gold and its relationship to stocks and why we have a great setup in the gold market. Let's first cover the bond market. So over the course of the last 4 decades, bond prices have gone up, yields have gone lower. The bet to be long the government debt products is really one in which you think the government will grow its debt at an accelerating pace. So if we go back to the log scale, linear growth is one thing, exponential growth is a complete other. And what we have coming to the US debt markets in terms of debt we have to sell that we can't collect from tax receipts is not linear. It will be absolutely exponential. So our forecast for the TLT is again for it to push above 200 potentially into this year and then into the 300s if this crisis really gets as bad as I believe it can into 2021. So it's going to be a slow grind on the TLT. And really the mechanism there is that they have to sell this massive deficit. So we went from a $1.1 trillion deficit in the US last year when everything was gravy, as our president likes to say it, the best economy of all time in history. Well, it was one in which our government was $1 trillion short of their budget. This year will quite likely be no less than a $2 trillion deficit. And next year potentially can go much more aggressive than that, as they're now talking about potentially doing monthly checks to anyone who's having trouble getting work. They're talking about a $2 trillion infrastructure project. And at the same time, we're doing tax holidays and bailing out everyone, no matter what. So there's They're not allowing businesses to fail, at least at this point in time. So I love the bond position, and the more they want to spend and the more they want to bail out people or companies, the more you want to own the bond position. So again, this is part of our pro membership, which we optimize on Thursdays. When I do add the puts, expect to also add the TLT calls. So typically we do this on a Thursday. I will make the call on a Friday after we have a series of H41 releases that do indicate they're going to stop buying treasuries, which again is super counterintuitive. The rate cuts are really what we want for the bond position to go up, which we have. The surpriser was their willingness to do quantitative easing before the problem was resolved. So I'll take a look at every crash in history and why the Fed's always done rate cuts, waited a year or two, and then done quantitative easing. And this time was different. So we are seeing them cut off the free money. And again, that is extremely bullish for bonds and very bearish for stocks, especially when you take everything into consideration with where the economy is headed. So gold, again, I'm expecting it could crash violently with stocks. So that's why we have put options. This is allowing us to buy the gold today. If we're wrong, we just work off the cost of the puts and GDX turns a profit for us. If we're right about the correlation between the stock market and gold, and the stock market does crash, then we lose very, 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 very little on our GDX position because we have two put options protecting it. So that's, again, the married put strategy. Now, so again, if there's a lot of upside ahead, GDX can do very well for us, and we just have to work off the cost of our put. If we do get a correlated synchronized crash in the markets that takes gold down with stocks, which without failure has been the trend, especially gold miners, then the advantage is, again, that we can start the clock for the 1 year hold time on our gold and then be able to sell the puts to offset any downside risk and then let gold continue to rise. As we get closer to 2021, around, I guess, March or April, that's potentially when we want to start selling GDX shares that we bought a year in the past and build into a silver position. As we do know, the 1-2 punch, when you have too much money sloshing around, is first you get a big rally in gold miners, and then after that has occurred, we can see just an absolutely insane move into silver. So that's really the core reason to hold the gold position in the face of a deflationary pressure where we know it's highly correlated to stocks. So is there a chance that enough people are going to front run gold and let it break past with the stock market? Certainly possible. And we have a lot of big hedge funds really pitching that right now. Although I'm still quite concerned that we will see a sell-off. So that's, again, why we have these put options protecting GDX. So let's review our positions on TLT. For every $75,000, we have 200 shares. That's a buy and hold recommendation currently, but it's protected with a cheap 162 put expiring 4/24. So the strategy here is you want your put to expire with very little value, meaning your core asset has appreciated. And again, that's the married put strategy. We'll be rotating this TLT put every Thursday and just keeping it right below the TLT. In case something goes wrong, our bond position is protected. Now, these three trades are a bullish bet on the TLT, currently buy and hold recommendations for new members. And again, I do anticipate aggressively adding a TLT call position really to every month in the near future. So I'll make that call on a Friday at the same time we add to our puts after we've seen, again, the Fed continue its trend of slowing down quantitative easing and potentially ending it for a period of time. Now on GDX, this is the only put that's currently recommended, the 28 put, and it gives you through 8/21 with downside protection. And again, I do intend to hold GDX and sell these puts if we get a significant pullback. If you have the 23 put, hold on to it. No point in selling it today. If we do get some drawdown in GDX, we'll sell both these puts at the same time. We're also betting that there will be geopolitical conflict between US, China, that the election will really revolve around pointing the blame on this to China and then connecting the dots to Mr. JB. And again, we have to be careful about what names we say, otherwise we get censored. But I do believe it's quite an easy connection and will be really the bulk of the president's reelection campaign. So what are some moves that could be made? Well, first of all, Chinese companies aren't audited. So we have to rely on their own internal reports because the Communist Party says that their accounting is state secret. So we know it's a bunch of BS and they put out all kinds of fake numbers. So that'll probably be the core logic to why it should not be legal for pensions, for all kinds of investors who have no clue what's happening, to have a percentage of their total wealth funneled into Chinese companies that are doing everything they can to dethrone America's power in the world. So that I do believe can be expected this year, is to see sanctions and restrictions put on capital flows to China. So our current trade to take advantage of that is the FXI put, the 31 strike, expiring November 20th. And no coincidence, this leads up to the election. So again, if it just crashes with the stock market in general, this was chosen to be essentially halfway from where I think it could go, which is a 50% plus correction. So we chose the strike that's halfway through there with enough time premium to sell it towards the end of the summer. Now, if they actually outlaw this American-based ETF, which is essentially takes the money and gets it to a foreign stock exchange, then they could cut this off and it could go to zero. So you would lose the cost of your put and pick up the value of the strike. So this potentially has a 30-to-1 return, and is if you're looking for a huge payday with low risk, then this is by far my favorite pick, and I think can have the highest return. I like our S&P 500 trades, and this does give us some good diversity, but we have more money exposed to US equities because those will again act as the hedge for us to buy US equities, which I think will be at a 50% discount this summer. So if you're in our boot camp, you know we have a trade just like this, which revolves around Hong Kong losing its special status and having a banking crisis, essentially. Now that trade has a 100-to-1 return with almost no downside risk. So it's very similar. I'd expect FXI to pay off first, and then unexpectedly, we could see that Hong Kong trade. Timeline, I'm highly confident in the FXI put paying out this year, this summer, whereas the Hong Kong trade, I believe we may have to wait into 2021 to see measures that aggressive. Now, could it happen sooner? Sure, but that's why we put in a 1% position into that Hong Kong trade Tuesday. So portfolio returns, the boot camps at 1% for the year. The drawdown is almost completely in our put options. And I do want to point out, if you cost averaged out your put options for the duration that these cover you, 2 years, your drawdown in April is minuscule. So I really wouldn't be getting overly concerned with drawdown in those puts. If you don't have the boot camp trades, which again, we have a nice winner on the QQQ, we have a nice winner on silver, and we just added the Hong Kong trade. So we got some very leveraged 1% positions that can really all double our entire portfolio in the boot camp bonus trades, with just 1% being risk. So that's a beautiful set of highly speculative trades that, again, only work if there's huge moves in the market. To get huge moves in the market, you need massive disruptions to to the financial system, and we got that. So I'm really liking the way our boot camp's positioned. If you don't have the boot camp, you're still doing fine. We're flat for the year. And again, if we average cost out those puts and understand that gives us what we want for 2 years of time premium, again, your downturn in April is really minuscule. Let's take a look at some, let me see what chat box questions we have popping up real quick.
A couple hands up as well, Jason.
Okay, great. Let me do chat questions first. Josh says he doesn't know why Amazon would go down. Well, imagine this. So Amazon has this valuation with everybody rushing out to buy stuff Q1 because they're afraid of pandemic supplies running out. And then at the same time, their income's getting crushed. Half of them are getting unemployed. So you really have to ask yourself, do you think Amazon's earnings will be as strong in Q2 and Q3 as they were in Q4 and Q1 of 2019 and 2020? And so I do think that every company under the sun, when you have a consumer-based economy, which America does, and especially Amazon's 100%, outside of its cloud services, it's the bulk of its income is from consumer spending. So if the consumers hurt, Amazon's hurt. And you can just look at how volatile Amazon stock gets. Let's just pull up that. I was just looking at that yesterday. So there's Amazon. But look, just recently you had let's put this on a percent change basis. So Amazon looks invincible right now, going straight up. It's got the best game in town. But again, if you have to reprice the consumer economy, which I believe will be at best 25% reduced, more likely 50% reduced for the next 1 to 2 years, then you really have to think long and hard about whether or not Amazon's going to have such a huge stream of sales when your consumer is just getting crushed. So that's really the analysis there. But yeah, you can see with small little downturns, this puppy can crash significantly. So I would be very skeptical to be buying Amazon at these levels. And we can see this crash lost just about, let's pull it off the log scale or off the percentage basis. Went from 2,000 down to 1,300. And this is just from treasury yields getting expensive. In the most recent crash, it went from 22 down to 16. So it's extremely correlated to the full market. And again, I do believe it will tumble down with everybody else. So yeah, they're going to have a killer Q1, but how will Q2 and Q3 look? Jeff says, when do you see the market downturn? I think it's going to happen shortly after the Fed stops printing money. And if they don't stop printing money, you have even bigger problems. Essentially, you lose faith in the value of the dollar. And so what we've done is essentially steal money from anyone who owns US products, debt, or currencies by just printing ourselves $1 trillion and handing it over to the treasury. We basically didn't ask anybody, took a loan for ourselves. And now we're gonna have to repurpose that debt from the T-bills to the treasury. So the combination of the Fed slowing down the growth of its balance sheet and then the treasury having to take short-term debt and convert it into long-term debt is going to just suck all the available money out of the markets. And also stock markets, so momentum-based. Every time you get a big, strong up move, the second it starts to peter out, you get the exact opposite. Everybody starts freaking out and selling, and then you get those vicious moves to the downside. So I think it'll be highly correlated to the government getting ready to sell its debt. Karen says we hit the 50-day moving average and it failed. So I do look at different indicators like that, but I think quite clearly it's the Fed printing $600 billion and pumping it into the markets is what really gave us the move up. And I think that'll be also what causes the move to go down. Pascal says Trump roll up of the forward phase plan should keep the market from crashing. So yeah, you know what? I don't think that has anything to do with the market going up, because market went up with everybody in lockdown. But what did happen was the Fed printed just under $2 trillion in a month and a half. So that's what it cost, which essentially devalued the dollar by a great proportion, because it went from 4.5 trillion balance sheet to 6.2. So you just devalued your dollar by about 30% to keep the market up for 1 month. Tony Cologne says China just announced doubling of COVID deaths. Yeah. Marlene, for 30,000, do you recommend I buy any FXI puts? Sure. Yeah. 1% risk would be a good position size, is what I did on that initial recommendation. Carmen says, hi, good morning. I'm on a trial and I have some questions. Why today's rally? Why are the puts so far out? And what about time decay, and why on those days is the open interest so high? How can I get a 10,000 account started? Carmen, if I was doing a $10,000 account, I would do the easier strategy, which is the buy and hold strategy right here. So instead of buying puts, we're going to take advantage of 3 inverse ETFs. So we have TEX, FAS, and Yang. TEX is going to take advantage of a lot of tech companies whose ad revenues are going to fall off a cliff. At the same time, the consumer is going to fall off a cliff. So love that. FAS is your banks. Banks are preparing for massive losses on all the mortgages they've lent. Also, they don't do well with interest rates at 0. So banks have a troubling time ahead. China, we can target with Yang. Again, I do believe we're going to begin to try to slow down China. It's really a multi-decade fight between US and China. Who's going to be the leader? China wants to take over their half of the planet, and US doesn't want to let them do that, as they do have some pretty extreme advantages. So we can dive into that in more detail, but an easy move by the administration will be to simply say China has fake data. We can't audit them. American companies have to be audited. Chinese companies don't. This is against the Security Exchange Commission's laws. So we need to ban all ADR products from China until they comply. So that'll be a very easy move that will give China a punishment and US a leg up. So I love that ETF. So if I had $10,000, I would just take this strategy right here and multiply it by 10. And again, you have some cash on the sideline. So that's what I would do. Rally is, again, the Fed printing money, and they're just gapping it higher and higher through the futures market. Very little of that actually traded through the day. Ross wants to know what I think of crypto, especially XRP. I think you're going to make more money with Bitcoin first, then Ethereum second, and only after those two get extremely pumped that you should look at something like good old Ripple. And I made a ton of money on Ripple, so that's actually my least favorite coin, but I know it's highly manipulated by the owners, and of course has a bunch of banks it's working with. Now, interesting in the crypto space is China's come out with a beautiful technology called DCEP. It's a lot like Facebook's Libra. So China's really taking the lead in a lot of different sectors, getting ahead of the United States. At the bottom of the crash, certainly we want to buy that ETF EEM once we do think we're at a bottom and not just the beginning of a prolonged depression. Real estate, I believe, will crash, Meg. I'm not sure how to protect the value of your house, but it's a very illiquid market. So probably the time to get out of real estate is today. Rent, wait for probably 2 years, and you should be able to buy a house half off. Now, it'll probably be some pretty strict requirements. So, but in terms of my outlook for real estate is very, very bad. Many businesses will not be able to survive when everybody's scared of getting sick. So yeah, I even though there's low rates, I do think there's some trouble ahead for real estate. So probably can get real estate 20 to 50% off depending on which area you're at. If you wait probably 2 years. Okay, we got more questions coming in. Okay, let me read some more questions coming in. Andrew says, would this be a good day to buy puts? Yes, sir. Much better day than I had. So it's not unoften that new people coming in get better prices than I do. Josh, no problem. And yeah, you know, the short-term reaction to Amazon makes a lot of sense. They're killing it. They're probably going to have the best sales of all time in history. I can't even imagine how outrageous their earnings will look for Q1. But how are their earnings going to look for Q2, Q3 when half the country doesn't reopen? The ones that do quickly see cases jumping up, and then we end up back into prolonged lockdowns. People are scared to go eat because one person sneezing could infect the whole damn restaurant. You know, who's going to go to a movie theater? It's just absolutely ridiculous until the fear that you're going to get sick from simply being around other humans has dissolved. Economic output's going to be really severely handicapped. Josh says, what about a Bitcoin? I think it's going to get crushed. I have orders to pick up Bitcoin personally at 4,000, 3,900, 3,500. And I do believe Bitcoin will outperform all other digital coins in the rebound. And then you'll see Ethereum kick in. And then you could see some of those other altcoins take off. So I would strategize that in that order. But yeah, we can see that Bitcoin gold miners are actually acting as a great leading indicator for when there's downward pressure in stocks, because it does look like the same people who are buying and selling stocks are also systematically buying and selling anything correlated to it, which again is gold and crypto, which all based on Fed printing money and inflationary pressures. And unfortunately, we have the exact opposite coming at us full force. Marlene says, can you clarify? So you're going to want to take no more than a $300 risk at this point in time, Marlene, because that's 1% of $30,000. So I think you'd be closer to 3 to have the same risk profile that I have. And remember, guys, the reason why I bet low and slowly build into a position with a lot of patience is because timing is really the hardest part. You can get the big picture right. People do that all the time, but nailing the timing is incredibly difficult. And the only way you can really master that is by taking controlled risks, managing your risk, and then having the right fundamental analysis to hold on to your positions. Because can you imagine how many people are going to buy stocks in this move and think that everything's just fine and dandy? Probably a lot. Okay, so Carmen says, thank you. I'll give this consideration so I can start with 1,000 and do the buy and hold. Yep, that's right. And multiply by 10. Yes, we can get you in for that. And you also get a 30-day freebie, Carmen. So I'll just show you guys where the option, these are our different products we have for sale. So we do have 4 products. Do you want to take a quick break and go over our different options, Dean, before I continue with all these questions piling in? And Dean's been getting absolutely slammed with coaching calls, guys. So, okay, great. Go ahead, Dean.
Okay, thanks, Jason. And thank you, Carmen, for the question. So Carmen, you absolutely can do it with 10K, okay? And we really kind of have the buy and hold portfolio for people specifically with less than 30,000 to invest, okay? And Jason set it up really cool because as he just showed you, you can literally build it per 1K tranche that you have. So yeah, you could just copy and paste that into the web browser and take advantage of those trades. Let's see here. And then Carmen asked, also, do you do any day trading? I'm a day trader. No, Carmen, we don't do any day trading whatsoever. 92% of all day traders either lose 90% of their money or lose all of their money within 2 years. So that's not an ecosystem we're generally interested in at all. But one of the neat things you'll get with the bonus is some really nice risk to reward trades that are free in the boot camp. So there's some kind of high alpha and seeing some funny comments come through the questions box there from the members. But yeah, you can absolutely take advantage of the bonus trades that we have in there. And I know most day traders are trying to kind of hit home runs constantly, which is absolutely impossible. But you could definitely take advantage of the buy and hold. We'll show you how to have a little bit better risk profiling in your investments. Okay, and also you can see that trade that Jason was talking about that he's looking for 100 to 1 payout on. Okay, and you'll never get that type of opportunity ever with a day trade. So it's really all about extending your timing. So just wanted to touch on that really quick. Let me see if we have any other questions coming in about portfolios too. Okay. Sounds good. Okay. Carmen, yeah, the trade alerts are sent out via text message and email. And that link that I sent you in the chat box, you can just copy and paste that into your browser and then just click the order button on the buy and hold portfolio. Okay. Let's see here. Okay, guys. So going back to reviewing the portfolios here, and if anyone has questions on a trial, please feel free to jump in. But on the basic option portfolio, guys, this is great for people that have between 30 and 70K, 30 and 75K, I'm sorry, to invest. Okay, it does utilize options, so you will need options, allowed with your broker. Okay, but really fun, guys. We are going to get to short the market. That's currently what we're doing now in the basic portfolio. Okay, and Jason said just now, if you want to pick up a contract of FXI to short as well, just make sure you don't go over 1% of your total portfolio, okay, if you are a basic member, okay? And that will help you guys build your portfolio and your net worth as the market tanks, okay? And we will tell you when to get back into the market in the basic portfolio. It's just, we got to see a lot of blood in the streets, and we're not even close to that point yet, guys, okay? And the portfolio, Pro Portfolio is option number 3 here. Okay, this is utilized with all of our clients that basically have $75,000 or more. Okay, and some people are using it with 75, some people are using it with multi-million-dollar tranches. Okay, and it's really going to show you how to trade like a hedge fund manager, take as little risk as humanly possible into the market at all points in time. Okay, and it's pretty cool. You get some awesome bonuses that go with all of these actually. But you really have a fun time. You're gonna get so I guess it's good to clarify schedule. So buy and hold will trade on Monday, right? So the least amount of time you're gonna need to allocate, okay, and the least amount of capital. The basic option, great for 30 to 75K, okay. It will meet Monday, Wednesday, and Friday, and potentially trade Monday, Wednesday, Friday as well. Okay, Pro Portfolio is gonna meet every single day but Tuesday, and really just if you have over $75,000, this is just such a smart way to hedge off risk as much as possible. It does take a little bit of capital to build that portfolio. So really it's, for our investors that are pretty serious and that have put a lot of their nest egg into their investments. And I absolutely love it, and I'm using it as well with a pretty substantial sum of money. Okay, and then below that is our boot camp. Okay, so our boot camp is going to be the educational side of what we do. We're really going to, our attempt basically is to take you from whatever level of trading you're at to a pro trader. Okay, teach you how the financial system works. Okay, teach you about a couple bonus trades that are sitting in there as well. And teach you about options inside out, upside down, and backwards, okay? And then also not only just teach you options, but show you how and when to invoke the different option strategies with your investments, depending on what's going on in the financial system and macro environment, okay? And the cool thing about the bootcamp is if you do that, you actually get a year of the pro for free. And then you get the education for life. So yeah, guys, that's our product offering, A to Z. And I would say to call me if you have any questions, but I am completely booked for today and for Monday as well. But you can certainly copy and paste that options link into your browser. Let me post it into the chat box real quick, and then I will let Jason get back to the presentation.
Well, thank you very much, Dean.
Thank you, Jason. Appreciate it, bud.
Oh, very good.
Okay, and that's back in the chat box.
Okay, great. I'm going to look at some more questions, and I do have a lot more content to go through, guys. So Jeff says he's guilty of buying some leaps from the money I saved from the program, missing the recent downturn. What'd you get leaps on, Jeff? Carmen says she'll think about this. Galaxy says, thanks, Dean. Ross says, thanks, Dean. Karen says it's all about the timing. 100% agree. Andrew says, should you wait until next week? Let's see, what is that in reference to?
He was talking about buying the puts.
Yeah, so, I wouldn't wait to buy life insurance. I wouldn't wait to buy health insurance, and I wouldn't wait to buy crash insurance in this environment. Now, could we have a little drawdown for another few weeks? Possible. Could we have a crash unfold at any moment because the big players start dumping these stocks that are extremely overvalued? We sure could. Because of the duration of those puts, which give you literally 2 years of time premium, and also understanding that I'm going to increase my relative risk per dollar invested in the near future, then I would say that time's not on your side. We can see a train wreck coming, and it's just a matter of a few weeks now before I think this is going to really start falling apart. Josh says there's no volume on the Yang ETF. You should be able to get filled easily, Josh. I wouldn't worry about that. And again, that play is essentially betting that they just straight up outlaw investment to China. And that's how you could hit that 30-to-1 return, at least with FXI. With Yang, it's going to be different, but it will go up if the FXI goes down. So just an easier way to have that.
Jason, and just wanted to clarify for you too, Josh. So we have the put options on FXI. In the buy and hold, that's where we're utilizing Yang. Okay, so don't want you to get confused. Options going on FXI. The buy and hold system has Yang instead. Okay.
Yeah.
So I think he might have got that confused, Jeff.
Okay. So yeah, we're long Yang by owning the asset because it's an inverse of FXI. So in the pro membership, we bought puts on FXI. You get a lot of leverage. It's really a huge advantage, but you got to get timing right. You got to get strikes right. So it's more complex. If you go with Yang, if FXI goes down, you make money, and they do all that timing and management of how to derive those profits for you. Carmen says, what about time decay? Yep, well, there will be time decay. But if you thought that this is it, this is as high as the market goes, and we have a 2-year depression ahead, you really don't want to buy puts later because you'll have missed the big move down. So So yeah, I really like our strikes. I like our expirations, and I will expand upon that as early as next Friday, but potentially we'll delay it another Friday. All I'm really looking for is to see, all I'm really looking to see is that the Fed is going to slow down treasury purchases, known as quantitative easing, which is the only thing keeping stocks up right now. And the stock market's so momentum based. The only way it stays alive is if there's a consistent supply of demand for stocks. But the truth is there's a consistent demand to sell stocks, not to buy stocks. And it costs them, they literally devalued the dollar by almost a third in 4 weeks. It's absolutely ludicrous. So that's what it cost to keep this market from crashing for the last 4 weeks. So market's going up because the Fed's printing money. They can only get away with that before people lose faith in the underlying currency, which is the dollar here. So a lot more to lose, losing the reserve currency. So I do anticipate they will. And the other big thing is they're going to have to start, again, rotating short-term debts, which is about $1 trillion they just put on the T-bill front end. So they don't want to roll that over every single week for probably indefinitely. This debt will probably never be paid off, right? So that's the scheme of the American government, is to go just rack up debt and grow it and grow it and grow it, and to go create chaos around the world to help fund it. So yeah, we had a multitude. We have this whole hype that we're past the problem stage. We're going to open back up the economy. Everything's going to be back to normal. But in reality, we're not going back to normal, not for probably at least 18 months, much longer possibly. We have to get a vaccine, or we have to just let this rip through society. However you want to do it, you're going to disrupt the economy dramatically, and that will cause a repricing in stocks. And if you crush your consumer, you got to remember, America's a consumer economy. So we're crushing our consumer. We're incentivizing to just sit at home, to not work and get paid. So you have inflationary pressures in that the cost of labor is going to go up because the government's incentivized sitting on your butt. And at the same time, you're going to have a demand shock. So prices can go up because no one wants to do the work. And at the same time, the amount of capital to buy those products is going to go down. So that's how you get the exact same setup you had in the Great Depression. It's going to be ugly. So little patience, guys. And I'll look at the 2008 crash. I'll show you, it can go up for 6 weeks in the midst of a massive market correction. And the magnitude of this is at least 10 times worse than the 2008 or dot-com bubble. The leverage in the market is 4 times that. Okay, so it's going to be too costly for the Fed to keep stocks valued this high. Craig says, is this message sent out to the people listening or the leaders of the webinar? I need to get the boot camp, I believe. Craig, this goes to all of us, and I'll have Dean get a hold of you to make sure you get the boot camp. Jeff says, I would have soon put options go up as we approach November. Yeah, I think that's pretty likely because quarter 2, quarter 3 will really be the nail in the coffin for the stock market. 1, and then 2, having to, again, sell trillions of debt that we didn't have to sell last year is going to suck all the money out of every market there is and right into the bond markets. You can't grow debt at an accelerating pace and expect stock market to go up. Bob says there's a huge straddle on FXI today for June. Pat says, is there a chart to show how much cash and credit available? So this will show you what's being used. They've essentially told everyone unlimited access to repo, which again doesn't let them sell the treasury, but does let them put it on hold. But yeah, let's look at the breakdown of the balance sheet. That's a great question, Pat. Kathy says, I'm following the pro with 75K. I now have freed up in another 30K. What should I consider? Oh, always difficult when you have a half lot, isn't it? Do you see yourself coming up with another 75, Kathy, or maybe put that into the buy and hold?
I'm not sure yet.
Well, buy and hold sure is nice and easy.
I've got one of my smaller accounts with buy and hold, and I'm trying not to confuse myself.
Okay, so you'd prefer to put this in with your pro batch?
I think so.
Okay, so I would say of the trades we have open, again, cut off these longer two. So I would do these three. And then you could do a half measure on this, a half measure on this. I'd probably maybe delete this one.
Generally, would you just say what I'm trying to do is
And
to,
I'd definitely take that one.
okay. So generally, I just need to make sure I keep half of it available for future.
That's right. We have about half our money in cash at this point in time. And that cash
Okay.
is sitting back ready to buy stocks at half off.
So I'll just do the calculations and see what pieces I can do. All right.
Logan says, FYI, the 2000 and 2008 both had a bull trap rally that each lasted for up to 60 days. I think it was more like 6 weeks. Now, towards the end of the 2008 crash, there was a 2-month one. But yeah, quite frequently they can pull off a 6-week dead cat bounce. Now, okay, Jack Tan says, Gilead Sciences found a cure. Is this true? No, there's a very manipulative hedge fund trader who went out and paid for a bunch of PR to go out yesterday. And Dean actually made some money on that. He likes to sit there and watch option volume spike, but it was completely fake news. And probably just helped some investor who was overly extended on Gilead get out. I think is what happened there. Oh, Karen tapped on that one too. So yeah, no, there's really no proven. And even if we do get a therapy, it still does not change the situation, and this is really the situation we can't escape. We can change how quickly it occurs. But if I was actually thinking the smaller stock market crash would occur if they let this rip through society faster. And the longer stock market crash would occur if we remain in lockdowns. Now, the administration was very clever. They can see on one hand, a bunch of people are mad at him for not protecting people. On the other hand, people are pissed off about losing their liberties. So they've come up with some guidelines that are quite generic that won't work whatsoever, not even close, and letting the governors make the decision so you can point the blame on them. So it looks like we're going to go from basically a general message to stay in lockdown to, it's up to the governor and it's not as important now. So I think that this will start to speed up and cause the crash to happen faster. Okay, keep the questions piling, guys. I will keep an eye open as I look at more data I want to share. Let's get through the news first and we'll look at some charts. Okay, so the first hit on China, we've already, so first hit was really the tariffs and trying to force China to rebalance its trade to be more fair with the US. Okay, Craig says I have 15K total, 5,000 in an IB account, 10,000 at TradeStation, 7,500 in a futures account. How should I structure my account? So yeah, I would think of it as one account and follow different parts of the system in different accounts. So rather than try to do the whole system in each account, which we've seen people do, and that's silly because it's really just one, your total assets. So let's see, your total, it looks like you have 22.5, right, Craig, or do you have 15? Or you just want me to allocate? I would do the buy and hold with 15, Craig. Buy and hold's beautiful. It gets the same exact job done. It's like having our pro program in terms of building the full house. You have the bonds, you have the stocks. We call the commodities, the electricity and the plumbing. You got the whole picture right here, and it's passive. I don't see us touching this till we get a huge crash. So you can literally build that, sit back. A lot of our crew loves come on these webinars. We haven't changed our position for about a month, but the whole crew comes on every day. And oh yeah, with interactive broke, I would move all your money to interactive brokers and take advantage of the cheap loan they offer. And then you could be following, you could probably follow the pro. So what's the difference? This one uses inverse ETFs. So inverse ETFs do a whole lot of work to be able to give you gains as an asset goes down. And you don't have to worry about expirations or strikes. You don't have to worry about timing. It's very passive, easy, really the cheater guide. And this portfolio has really kicked ass, not to downplay our more expensive programs. In a normal market, it just really kicks ass. It's passive, it's easy. It's going to have more volatility. What it can't do is give you extreme leverage. So the big advantage to our more advanced programs that use options are these leveraged option plays. Now, you're going to have to be patient. You're going to have confidence. You're going to have the right risk management, the right strike, the right timing. You're going to have to react to things like the Fed coming out and printing $1 trillion. But with that all said, the option market gives you extreme leverage. Like this trade, we can pay $1 or $100 for a put. And if the US goes and outlaws investing in Chinese corporations because they don't have any auditing, and Luckin Coffee made up something like 75% of its sales recently, well, then that could go to zero and you're going to get a 30-to-1 return. You cannot get a 30-to-1 return with an inverse ETF. Okay, so options have some extreme advantages if there's a big disruption to the economy. John says, with buy and hold, you have suggested 3 inverse ETFs. These are not calculated daily, so is a good idea to leave for a month. Yeah, so I'm going to let the relative value or the percentage held in each asset go up and down. Because if I wanted to recalculate that, we'd be buying and selling and optimizing every damn day. And that's not conducive to getting that low tax rate. So you'll see I always try to nail 1-year hold on our assets so we can pay half the taxes. That's huge over time. If you have a long-term methodology, you're not trying to hit quick little wins, well, you can get bigger returns and catch the big moves and you can pay half the taxes. So yeah, I would just buy these ratios and sit back. I don't see this changing until the market's corrected 50%. NMI says SPY's at 284. I bought it at 240 NMI. We went to 220 in the futures market that Sunday, and then the Fed came in with about $500 billion a month for the last 3 weeks. But we had limited risk, and we're going to increase that exposure. So, Pat, the Fed has no limit. They're not borrowing from anyone. So they have unlimited credit, and the risk is that they're trying to, they say their goal is to keep employment and control inflation. But really what are they trying to do is protect the banking system, keep the government funded, and protect the dollar is what I would argue is their goal. So they have unlimited credit, but they risk losing the value of the dollar. as far as watching the balance sheet, this is your chart from the St. Louis Fed. I'll post that to all attendees. Here's the balance sheet in a written format. So they update this every Thursday after the market close, way before they seem to update this chart right here. But we can see they tend to do a quick fix and then sit back and see if the market can hold on to it. MI says, so we can still buy at this. Yeah, so you can get a great discount compared to me and MI, which is beautiful. So people just jumping in now really have a beautiful entry point. You know, who would have guessed that the Fed would print $1 trillion in 3 weeks? So that is giving people coming in a great opportunity to build our entire portfolio. And you'll outperform me, but keep in mind, I am going to add more exposure too. So that's just the starting point for building that position. Okay, let's look at some news. Meanwhile, the Fed is buying junk bonds by the billions. So again, the Fed had to make a choice, let the whole thing come apart, or bail out everyone, even if they have lousy business models. That was a short-term fix, but again, they can't just do that forever. You risk losing faith in the currency. And that is America's greatest asset. So they have limited ability to do that. Essentially, we just stole $1.5 trillion from the world to pull this off. Okay, guys, everybody say bye to Dean. He's got scheduled meetings, so he'll be off for the rest of the call. Thanks so much for getting everybody going there, Dean, and explaining how this all works.
Absolutely. Thank you all, team. Appreciate your time and attention. We'll talk soon. Thank you, Jason.
Thanks, Dean. Okay, Berkshire, remember, has a ton of money on the sideline, something like 1/3 of their entire portfolios in cash. Watch, China blocks U.S. companies from getting their money out of China, and now they can't get their supply chains out. U.S. companies in China haven't been able to get their money out for 4 years, and now we're being told that maybe you can't get your supply chains out. Everybody wants to get out of China. Peter Schiff, it took the Fed a bit longer to finish the calculations. Yeah, I sat there hitting F5 all evening. Marlene says, shouldn't I be buying the ETFs in the buy and hold portfolio? So Marlene, I would either do one strategy or the other, not both. Some people are doing both, and you could, but realize the buy and hold is all on its own. You don't need to do anything else outside of that. If you want to follow that, if you want to follow the basic or the pro system, then you don't need the buy and hold. So it's really one or the other makes the most sense. So yeah, Fed took a while to get that release out. Who knows why? Maybe they're trying to let all the attention go to the reopening of the economy as they snuck in a bad print. So if anybody's playing the stock market based on balance sheet expansion, you did not like that print yesterday. And I do suspect it will be disappointing here on out. Okay, meanwhile, the small business loans run out of money. And again, they're hoping that if they loan all these people money, they have to pay 75% of it towards staff rent. But most of these businesses they're not going to work in the new economy. Ross says, why is Schiff always rooting for the demise of the U.S.? Isn't that? I think he has money from China. Because he's always pitching just two things, emerging markets and also gold. So that's really his call always. Yes, Mike, the SLV trade is beautiful. Absolutely. Mike just joined the boot camp. Very good question. The QQQ trade is now attractive again as well. John, go ahead. And I'll keep an eye on the chat box as I read the news. Here's your high level Chinese communist. I guess the PR for the US from China is what this guy represents. China has not seen a wave of unemployment like that of the US so far. Companies are asked not to lay off people during the pandemic. This is socialism. China is speeding up production resumption and minimizing bankruptcies. The CPC can lead the country through this difficult time. Gary says, will you be entering a trade to enter? You're talking about Ethereum, Gary?
Bitcoin and Ethereum.
Yes, sir. I'll do that in the boot camp trade. So definitely.
Okay, thank you.
But yeah, I got an order sitting there at 3,900 on Bitcoin.
What do you mean? You got an order to buy at 3,900?
A limit order, yeah. So not a market order.
Okay.
Yeah. And it could go below that. So realize I would not go over 1%. And even though that will be during a 50% sale, it could go much lower than that.
Okay.
Also interesting to see China with their DSEP product. That's exactly what Facebook wanted to do. Okay, the brave new world that will follow the crisis. Where will the populist backlash find a home? Last time it was banks, maybe the Fed. Clearly, globalization would be unwound apace. But will big tech be dismantled like big oil was in 1910? Okay, so they're showing when you get too much concentration in a handful of companies, it tends to mark bubbles and market tops. So we can see 2000 was Microsoft, GE, Cisco, Intel, Walmart. Interesting. Only one of those was able to last for the last 2 decades. So we got Microsoft, Amazon, Apple, Alphabet, Facebook. So again, I think all of those businesses are going to be severely disrupted in what's coming down the pipeline. Amazon will be hit by a hurt consumer as well as Apple. Microsoft is going to struggle as so many businesses are disrupted. And then Alphabet and Facebook, again, advertising budgets are going to drop in half for many, many companies, if not to zero. So this is just a total disaster waiting to unfold, and does lead me want to short that group of FANGs outside of our already very well-positioned portfolio. Okay, oil cuts. So again, if you see oil dropping in value, plus you see everybody cutting production, that tells you the real economy is suffering. And again, another leading indicator to understand what's coming ahead. Here's a detailed little piece about that. Gilead fake news that came out. There's a whole Zero Hedge article about it. And they did come out and say this was just anecdotal data. Not going to read through it all, but essentially a dirty hedge fund manager who's well known for doing these kind of moves got this big old PR stunt to come out and went and put a ton of money into a 1-day expiration call option. Complete fraud. So about 94% of restaurants in China saw the number of customers tumble by 50% year over year in March, according to China Hotel Association. They also had that very nasty print, even though we don't typically believe Chinese data. Global central banks tapped the Fed's Forex swap lines for $55 billion in the past week. So we can see the European banks really tapped it. Last week, the week prior, the Bank of Japan. And this, sorry, these big spikes were during the crash. So these big banks ran out of dollars as everybody was trying to convert assets denominated in dollars at the same time. And again, if we realize there's hundreds of trillions of dollars associated to the dollar, and the Fed only has now 6 trillion in the balance sheet. So if everybody tries to sell something at once, there's just not enough real dollars in the system. And that's when we get these dollar crunches. Here's China's growth, just catapulting lower. And it's probably worse than that. We know China likes to fudge numbers. Now they could be trying to cause a market crash, so they could be trying to put out negative news um, to help put pressure on U.S. markets. Quote the Raven's always funny. This is so sad and sickening. People are trying to front run the Fed by buying junk bond ETFs that they shouldn't be buying in the first place. And people ask me what I'm talking about when I talk about moral hazard. So BlackRock's running that whole scheme. Here's a new ad being ran by State Street. The Fed's buying ETFs. Here are 7 we think they will consider. But of course, now the Fed's slowing down their purchases and probably will dramatically drop it down. Will Amazon abruptly close all of its job openings? It announced over the last few weeks as everyone can now freely go shopping in the real world. He's talking about the end of the lockdown, supposedly. Kathy says, what platform do you use to buy Bitcoin? I like Coinbase. It's an American company. It's well funded and very secure. I like the phone app to hold it. And if you use Coinbase Pro, you can deposit money into Coinbase Pro with no fee. And then you want to do a limit order and you can really get a free trade. So that's the cheap way to get in. If you just go buy it from their platform with your debit card, they're going to rake you with huge fees. So deposit cash into Coinbase Pro first, no fees, absolutely free. It takes about a week. And then I would sit with a limit order to buy Bitcoin around below 4,000 is where I think we could catch it. Okay, John says some of us in the last 3 weeks got out of equities when it was down 30%. Now after getting out, we have missed the 20% bounce. Is the best strategy to forget about the lost 30% and slowly chip away following the buy and hold? I have 30K. Yeah, for the buy and hold, you can build it and sit back. So that is set to jet. I don't see that changing. If you want to cost average in, you put in, say, 10,000 a week for the next 3 weeks. That's not a bad idea. If you want to just put it in now, I think that's also not a bad idea. Ross says, does Coinbase accept credit card deposit? No, if you'll have to just buy it from their website from Coinbase and pay all the fees if you use a credit card, I believe. If you do a bank transfer deposit, it takes about a week. There's no fees. And then if you're a market maker, instead of then you can actually get the free trade if you're a market maker. So we could cover that more when we start to see the stock market start to pull back. Are they still going to pay oil drillers not to produce oil since everything is going to return to normal imminently, which it's not? Profit warnings from Chinese companies have been piling up as many businesses say they took a hit in the first quarter, a clear sign that the outbreak has sent shockwaves to the nation's economy. The real change here is going to be the consumer behavior. The fear of being around other humans is going to have a long-term consequence. This is a bullish fellow. Tomorrow may be one of those days where the market is just grinding higher with guys rolling short calls from 2,800 and buying equities all day long, orders getting hit, and every offer getting lifted kind of day. We shall see. So bad news for this fellow is the real buyer, the Fed, is not growing the buying, but slowing it down very quickly. Breaking, Japan declares nationwide state of emergency. So there's another hit to oil demand. China's retail sales fell 15% March versus the expected 10%. The U.S. is launching a massive anti-China campaign via the media right now. If you cannot see the writing on the wall, supply chains are leaving China, cannot help you. So, and that's actually been the case for well before this happened. China Q1 GDP, negative 6.8. So we can see the magnitude of this is absolutely devastating and just getting started. Okay, so I think that gives us the most recent news data I want to cover. Let's look at some charts. Okay, so first of all, this is the Treasury auction site. How did we come up with $1 trillion to fund all this stuff with very little time? And the way we did it was T-bills put straight on the Fed's balance sheet. But again, we have to roll this over every week. They're rolling over this debt. So they don't want to do that. But it was a quick solution. They got the money straight into the Treasury's coffer, and they've been allocating that to all the super rich so they don't have any pain, and a little bit to obviously the labor force. But now they have to get this moved from the T-bills to longer duration debt. And that's what we're really looking forward to with our position on the TLT, is that we're going to grow the size of the debt. And this is really the key here for what's going to suck resources out of the economy and start actually funding the real debt that we're issuing. So that should be coming up soon. They tend to just sell the 30-year on the first week of each month. So that'll be coming up early May, and we'll see how aggressive they get. But they tend to take advantage of market fears when yields are dropping to expand the debt offering at the same time. So would not be surprised if there's some news flow that really helps them convert the debt from short-term to long-term coming up. Here's a look at the yield curve. Every time it goes inverted, recessions occur, and that was no exception this time around. So in January, we saw the yield curve invert. February, it came more inverted. Fed came in, dropped rates again, and did trillions in treasury purchases. So they were able to drag these yields very low. And the result was the 30-year treasury yield has slowly but surely been dragged lower and lower and lower. And again, that's what we want for our bond position. Remember, a bond has two parts to it. You have the bond value you get at the end, and then you have the yield you get every year. And so it's one or the other. You want a big yield, or do you want a big bond? And so if we buy at a one yield and then the yield goes lower, then we're making money on the bond. And so quite clearly, we're not interested in making 1.2% for 30 years. We're much more interested in that yield going lower, and we get to flip the bond to the Fed for a big profit. And typically, let's talk about the mechanism and how this works. Remember, banks love troubled businesses. They come in with a convertible note. It's a sweetheart deal for a bank. If the business fails, they can come in and have first rights to your assets and get their money back plus interest. If the business does well, they make their loan back plus the interest. If the business does okay, survives, but they can't pay the loan back, then they convert that into a huge chunk of your company. So banks love problems in the economy because that's how they can take advantage of it and loan money out. If the problem is too great and a single bank can't swallow the economic loss, then we have to use the government to do that. And don't you forget, the Fed and the government and the banking system are one team. So if we get an economic crisis that no single bank can fix, it's the same strategy every time. The Fed makes the cost of money near zero. The banks borrow the money from the Fed, loan it to the government. The government tries to go fix whatever economic loss is being troublesome to the economy. Once the problem is fixed, those banks get to have their bonds purchased back from the Fed for a profit, and then the banks get to buy up stocks super cheap. And so like clockwork, every single recession, the same plan plays out. And so I do suspect that the Fed has to stop letting people sell their treasuries so that they can force investment into the debt market. We still haven't actually raised the capital we need to fund the current crisis. And that's going to happen as they convert the T-bills into to the bonds. So typically, again, they cut rates, fix the problem, then do QE. So the problem was so great this time that people were going to sell their treasuries because they're losing so much in stocks that they did indeed sell treasuries, stocks, oil, everything at the same time as we had a huge liquidity crunch and everybody needed dollars. So that does explain why the Fed had to do QE and rate cuts back to back this time around. But I would expect again that this balance sheet growth comes to a halt. This will force everybody to buy and hold treasuries, be devastating to stocks. And then after all the money's been raised, then the Fed comes in and lets everybody out of that investment for a profit, not before. So they were just trying to stabilize the global economy here. Otherwise, the whole thing was going to crush in March. I mean, we would have had chaos worldwide. So this bought them some time, but it did not fix the problem. So from our perspective, we're going to make more money, not less. There's going to be increased volatility in the stock market. We're getting to add to our exposure at higher levels. And also this gave us more time to prepare and get situated. So really not concerned at all. This is the yield curve. I show this just to get a big picture of what the value of the 30-year treasury has done over the course of time. And essentially, it just goes up in value as the government loves to print money, more money than they can make. So that's been a constant trend, is that the banking system and the governments worldwide are addicted to debt. They're power hungry and they're money hungry. And that's one thing you can count on, is they will grow that debt. And they know if there's a crisis that it equals payday for the government. It's basically free reign to print money, hand it out to all their buddies, and get away with it while no one is really understanding what's happening. And so the pace at which we're growing the debt in 2020, 2021, probably 2022, will be the fastest growth of debt for the US in its history. So let's just take a look. Remember, there's two parts to your bond, the yield and then the bond. So if you get a better yield, you're going to get less money for your bond. So 8% a year would be quite nice right now, right? But imagine you bought that and then sat on it, and in a decade, it had seen its yield drop. See where it goes in it. In a decade, you'd still have 20 years left on that bond, and it had crashed to 6. So the value of your bond skyrocketed, and you're still collecting that great income. So the bond investment's really the single best investment of the decade if you're looking for low volatility and extreme safety, because this trend, if it breaks, the government's not funded and the stock market goes absolutely haywire, because the entire growth of the stock market has been based on the growth of the US debt. That's really the big factor growing this. So it's going to grow and give us a massive stock market rally after the money's taken out of the debt market and back into the stock market. So just over the course of time, we can see that yields going from 6 to 5. For a little while, they took out the 30-year and put it in the 20-year, and then came right back to the 30-year. 4, little bounce to 5. Now, really the caveat, the only time the bond market really has trouble is when you have absolutely perfect conditions in the stock market, where there's revenue growth, profit growth, and the earnings versus the price makes sense. So the few times in history where bonds go against you is when the stock market is truly healthy and people want to own stocks because the future is so promising. And what you'll see during this most recent rally in the stock market is the bond market has gone up. So that means the stock market is just the Fed printing money. It's nothing else. Okay, so over the course of time, these yields drop, they drop, they drop. And if we get to current present time, we can see that yield sitting at the ultra low level of 1.2. So my expectation is that 30-year Treasury will first go back to the most recent spot we got on April 9th was when we saw a intra return of 15% our portfolio. And I had us hold too long, and it ended up turning into a situation where central banks had to sell treasuries to try to stabilize markets, and they were out of dollars. Okay, I do see some questions piling in. And some questions out there. Ryan, you want to go ahead and allow Sue, Galaxy, and Bake to have questions? Go ahead, Galaxy. Vulture financing. Yeah, you got it. So as I keep scrolling down, you can see these interest rates just continue to go lower and lower. Oh, interesting, Pat. And then we can unmute Pat too. So,
Yeah, this is Pat. Can you hear me?
Hey, Pat, how's it going?
Real good. Yeah, I've been tagging RSS feeds and stuff like that anytime something comes through for antivirus or antivirus testing, just to see if people have the antibodies in them. And it's a Stanford test that came out in the last hour. And they are estimating that right now in that area, it's not obviously a national test, but they did 3,300 people, and it's somewhere between 2.5 and 4.2 people had the antibodies. That's 2.5% to 4.2%.
Wow, look at our model right here. Pretty close, huh?
Yeah, it's not bad. It's better to be on the higher side too, right?
Yeah.
For your model.
So just so everybody knows, Pat offered to help do extra research for me. And I told him we got to figure out how much of the population's already had this, because that can change your timeline. And so if we thought that half the population already had this because it's been going around for years and just no one was testing it, then that shortens the time frame to getting herd immunity. So herd immunity is 60% of the population. And so at best, we're at 5. I mean, that would be at best, probably half or less. So great news to report, Pat. Really appreciate that.
And one other thing I noticed, well, they didn't give the test. They just tested that ship where that captain was discharged from.
The Roosevelt?
Yeah, the Roosevelt. And you'll notice that I think 40% of the people had the, I don't know, somebody should look at that and try to make a prediction from that like you've done here.
Sure.
I couldn't imagine.
I have the data memorized. So it was about, I think it was about 5,000 on the ship.
Yeah.
So this is military. These guys are hardcore. Okay. These guys are obviously going to be more precautionary than us. I believe about 500 caught it. 250 were asymptomatic. 250 got sick. And I think 1 or 2 died so far.
Right. So the question is, what's the for me, somebody should be able to figure out from that information who has the antibodies, meaning they're like in a petri dish. Is there almost no way they couldn't have touched and got the virus on that ship or any ship. So we should be looking at ships to get that information, which is not public. I think, like for instance, Japan might not be too quick to share that or
well, in the cruise ships, we're getting almost a third of the cruise ship infected, and then they start hiding the data and ship everybody off.
Right.
Yeah.
So
Okay, very
anyway.
good. Yeah, so
All
I
right,
think
cool.
our
I'll
models,
keep looking.
I
I'll
think
keep
our
looking.
model is dead on here. So very good, and it's great to get evidence that does absolutely back up our analysis. Thank you, Pat. Okay, if anybody has questions, go ahead, please. I'm going to keep going through. Okay, so bond market goes up if debt grows at an accelerating pace. Without question, that's in the future for America for at least two, probably more like 3 to 5 years. Logan says, Jason, think about it logically. If half of the population had this, such as the bogus notion that we all had this last December, if that were true, then why did the death rate only spike up in March? Clearly, the virus has only begun its spread in February. 5% of the USA sounds about right. Oh, yes, certainly, Logan. So I just always want to play the devil's advocate, and I do think it's a lot less than 5%. So if we thought more people had it already, then that would change our timeline. So that's why we definitely keep close eye on that. And they're supposed to get the antibody test coming out next Tuesday from Abbott with the speed testing. So that'll really get a lot more data in our hands, hopefully. Okay, so economic output is going to be crushed. Bond market's going to hog all the fun. What else do we need to worry about in our investment vehicle? Inflation. So let's look at the Dow over 100 years. A lot of people get this mentality that stocks can only crash 50%. And that means that it oftentimes doesn't make sense to sell ever because the tax consequence is just as bad as the loss. So if you think about it from that point of view, you get incentivized to buy and hold into drawdown. Karen says a few minutes ago, the WHO reported that the antibody test does not prove you have immunity. Yeah, so it looks like they took the SARS from 2003, which was transmitted from a camel, very lethal, but not very good at spreading. Then they took the bat SARS, which doesn't normally get humans, but spreads really fast. And then there's some pieces from the HIV genetic code that's identical. So it seems that there could potentially be much more long-term ramifications of this disease than people think, that it can be attacking your body from different entry points. Right now, we're